On November 17, 1982, no president gave a speech, no breaking news alert went out, no headline ran the next morning. But that afternoon, 5 unelected regulators quietly rewrote a rule of American capitalism. They didn't pass a law, they approved a technical footnote called Rule 10b-18. Before that footnote existed, one specific action was treated as a federal crime. After it, that same action became a multi-trillion-dollar habit. The action was simple. A company buying back its own stock. Today it happens so often nobody blinks. Apple does it, Google does it. So does nearly every company in the S&P 500. For most of the 20th century, that same move could get you prosecuted. The old rule. For nearly 50 years, that single move was treated as manipulation, not metaphorically, literally, under the Securities Exchange Act of 1934. Congress wrote that law after the 1929 crash, exposed how insiders quietly inflated stock prices. Groups of traders would buy shares together in secret. They'd push the price up, then dump everything onto the public. Regulators built the SEC specifically to end schemes like that. A company buying its own stock to push the price higher looked exactly like that crime. It was the exact behaviour the law was written to stop. So for decades, most corporations simply avoided it. Profits went elsewhere instead. New factories, new hires, research budgets, sometimes dividends, paid straight to shareholders. That world ended in one quiet afternoon. The rule itself. The SEC chairman in 1982 was a man named John Shadd. He was a former Wall Street executive, appointed by Ronald Reagan. Under Shadd, the commission proposed something called a safe harbour. Meet 4 narrow conditions, and a buyback could no longer be prosecuted as manipulation. Use a single broker per day. Avoid the opening and closing minutes of trading. Never outbid the highest independent price. Stay under 25% of the stock's average daily volume. Check those 4 boxes, and the SEC would simply look away. On paper, it reads like a routine compliance memo. In practice, it functioned like a switch, flipped for the entire American economy. Nobody outside a securities law office noticed at the time. The immediate effect. The effect was almost instant. Buyback volume tripled within 12 months of the rule taking effect. In 1980, before the rule existed, American corporations spent $6.6 billion repurchasing their own stock. By the year 2000, that figure had grown to roughly $200 billion. By 2018, companies announced more than $1 trillion in buybacks in a single year. In 2024, executed buybacks hit a record $942.5 billion. In 2025, announced buybacks crossed $1.38 trillion. Add dividends on top of that, and shareholder payouts topped $1.6 trillion in one 12-month stretch. One narrow rule, a 40,000% increase in volume since it passed. The hidden incentive. Here's the part that never makes the evening news. Around the same years buybacks were legalized, something else was shifting quietly. Corporate boards began paying CEOs mostly in stock options, not salary. That single design choice tied an executive's personal fortune to one number, the share price, and a buyback is the fastest way to move that number upward. A company doesn't need to invent anything. It doesn't need to build a factory. It doesn't need to hire a single new engineer. It just needs to shrink its own share count. Earnings per share rises on paper, even if the business hasn't actually improved. The executive's options become worth more overnight. The workforce that built those profits sees none of it. The human gap. In 1982, the average CEO earned roughly 50 times what a typical production worker made. Today, that ratio has climbed past 140 times. Meanwhile, inflation-adjusted hourly wages for typical American workers barely moved. Between 1964 and 2018, real wages grew by only about 12%. Over 5 decades, ordinary pay crept forward by inches. Executive pay detached completely and sprinted ahead. The mechanism connecting those two facts sits inside a rule almost nobody has heard of. Scale today. Apple alone spent $104.2 billion on buybacks in 2024. That followed a $110 billion buyback authorization. It remains the largest single repurchase plan in corporate history. But stock ownership in America is not spread evenly at all. The wealthiest 10% of the country owns 93% of all stock. The bottom half of Americans own roughly 1% combined. So when $1 trillion flows into share prices, not wages, most of the country misses out. They own almost none of the asset being inflated. The defense. Defenders of buybacks make a real argument, not a throwaway one. If a company has cash it can't reinvest well. They say, giving it back beats wasting it. A bad acquisition can destroy more value than a buyback ever would. Buybacks also let a shareholder choose when to sell and pay tax. A forced dividend gives everyone a tax bill immediately, whether they want it or not. Some economists argue buybacks are simply dividends wearing a more efficient disguise. That argument holds up when a company truly has no better use for its cash. The harder question is, who decides that and how often they're right? The people deciding are the same executives whose pay depends on the stock price rising. That's not proof of wrongdoing. It's a conflict of interest baked directly into the decision. The pushback. A few lawmakers have noticed this over the years. Senator Elizabeth Warren has called buybacks a sugar high. Prices rise short-term, while long-term investment quietly starves. Legislation called the Reward Work Act tried to ban open market buybacks outright. It also tried to repeal Rule 10b-18 completely. The bill went nowhere in Congress. In 2003, the SEC quietly tightened its disclosure requirements. In 2023, it tried again, demanding more frequent repurchase reporting. But the safe harbour itself, the actual legal shield, has never once been repealed. The counterfactual picture, a version of America where that footnote never got approved, trillions of dollars that flowed into share prices flow somewhere else instead, toward research labs, toward new manufacturing lines, toward wages that might have kept pace with productivity. We can't rerun history to confirm it, but the money existed either way, every single year. The only question was ever where it would go. A boring rule from 1982 helped answer that question for 4 decades, quietly, without ever asking anyone's permission. What it means for you. Here's why this isn't just a history lesson. If you hold index funds, you own a small slice of every buyback. Rising share prices quietly help your retirement account too. That's the part Wall Street likes to mention. Here's the part it doesn't. If your income comes mainly from a paycheck, not a portfolio, the math flips. Wages grew 12% in 50 years. Buybacks grew 40,000% in 43. You can be helped a little and harmed a lot at the very same time. The size of each effect depends entirely on which side of that ratio you're standing on. Most Americans, statistically, are standing on the wage side, the quiet part. No senator ever voted on Rule 10b-18. No president signed it into law. 5 SEC commissioners approved a technical release. The American economy quietly pivoted around their decision. That's the quiet part of this entire story. Nobody had to convince the public of anything. The public never had a reason to look. The rules sounded far too boring to make headlines. 43 years later, trillions of dollars move through that boring footnote every single year. Most people paying for groceries have never once heard its name. Close/open loop. Rule 10b-18 didn't make anyone rich by accident. It rewired the single biggest incentive at the top of corporate America. It did this one legal footnote at a time. And the people who benefited most from that footnote helped shape something else too. They helped shape the rules governing the retirement accounts most Americans depend on today. That's a different quiet rule, passed 6 years earlier. In 1978, it touched almost every working American. Through a retirement account most people trust, without question. We'll get to that one next. Next time you look at your paycheck, remember Rule 10b-18. Thanks for watching. Subscribe for more deep dives, and I'll meet you with the next video.